Trade Genius.
Hey guys, welcome back to the Trade Genius podcast. Philip here with Bob Kudla. Today we're going to talk about the Fed Divot. So Bob, we know divots don't look so pretty on the golf course, especially after a bad golf swing. So what are we digging into today with the Fed?
Um, yeah, look, I think it's a great name, the Fed Divot instead of the Fed Pivot, because I think the Fed is digging themselves a hole here in terms of their policy. They're obviously not going after inflation. They're going after something, far more strategic, and I think it's going to cause some great grief if there's no turn here soon. Because I think the macro data we're going to show you guys, we've been giving you bits and pieces all day. I mean, all week about macro data not supporting the Fed's assertion here of inflation, and I think the just like the golf swing here, it's gonna cause some great pain in the economy, and it's gonna make the Fed look like idiots once again.
Yeah. All right. So let's dig into some of the material here. First up is we have these swap lines now that they've been opening for 9 additional foreign central banks. And so, Bob, what's your take on that? This on that move by them?
Yeah, so this is their way of it's basically the silent QE. Is that the dollar is so strong against these other currencies that they have to provide they're providing collateral to get their hands on dollars because there's a dollar shortage around the world caused by the Fed.
Hmm.
So they're doing some swap lines for these central banks to get their currencies and economy and their banks back into some sort of onside versus the offside that they are now. And and that's what really pisses me off about the Fed here because he's talking all hawkish, but behind the scenes, he's like, okay, you go to bed without breakfast or dinner, or whatever, and then they turn around and mom brings the dinner up to the bedroom, right? So that's exactly happening
Right.
here. Everybody thinks you're getting he's being hawkish, but he's being dovish to his basically the elites inside his organization.
Yeah, and then actually it's funny because if you dig deep enough on their site, one thing about the Fed, they're mandated to provide the information, right, that they're executing on. That's how we can find out things like the amount of liquidity the Fed's providing to the markets. You have to dig though, and they actually do have these explanation of these liquidity swaps on the site. And I thought it's interesting that it says right on there, coordinated action to enhance the provision of liquidity being the standing U.S. dollar liquidity swap line arrangements. So, like, what can we take away from that, Bob? What is that telling us?
Yeah, so how this works, and the reason why you need liquidity in the first place is that you know you may have a need for dollars, but all you have are illiquid assets. You have loans on your books, and you have collateral, but none of it's cash collateral. But you have a client within your organization that actually needs the cash. Okay, you owe them the cash and you don't have the cash. So you have to go and take one of your assets that you have on your books, hand it to the Fed, and for the Fed to give you dollars.
Got it.
And that's what the swap line, essentially what they are. And that's what they mean by liquidity because it's giving you a temporary grease here to do what you have to do to eventually move your assets around internally to generate the cash, and then you flip that cash back to the Federal Reserve, and you get your collateral back that they basically look. The Federal Reserve is a big pawn shop, okay, and you handed them your guitar, and they hand you cash, and you promise that you're gonna come back for the guitar and get your cash back, okay, less whatever interest rate or fee that they charge for that. And that's essentially what a swap line is. It's a big old pawn shop.
Right. Except I think in real life, a pawn shop, you got to have something of value, right? But when things hit the fan, these banks have a bunch of toxic assets and they don't care. You might as well be turning in diamond rings when you got a trash can full of trash. They don't care. They're just going to make the swap to keep the market stable, right?
Yeah, that's a really good point, Phil, because the bank that's asking for the cash gets to keep the value of the asset on the book as to when they collected it.
Hmm.
So even if it's down 90%, as long as that asset is not what they call impaired, meaning if somebody's making payments on it,
Hmm.
they'll say, "Oh yeah, this 100,000 thing, but I got it for a million, so it's worth a million. So give me $1 million in dollars." And so that's what happened in 2008, and that they were actually having to write those lines down, those assets down. The banks got in big trouble. So what they do, instead of trying to solve that problem for the future, they just changed the rules and said, "Oh,
Right.
you don't have to write those down ahead of time." So you never know when a bank's really in trouble because as long as somebody's making a nominal payment, that's why you saw a lot of times when they would have those things saying, "Hey, if you could just pay anything," right? That way they didn't have to write down their collateral on their books and they could just pretend it's still good. And that's the same thing here. I'm sure they're handing the crappiest assets to the Federal Reserve. Ones that, hey, if it blows up, blows up. They're not going to give their pristine stuff. I guarantee gold's not moving to the central banks to get those dollars. I guarantee you that.
Yeah, it's definitely a club that we're not in, and the rules are definitely different. Speaking of liquidity, Bob, we had this chart I wanted to bring up. So we have this chart of the global liquidity index long-term cycles. And if you're just listening, basically this is a chart that oscillates up and down. And right now we're at some of the lowest levels we've seen basically since like that era of the '07, '08, where things really started to get unstable. End of 2018 going into 2019, we're at those levels, which both of those eras where a lot of financial instability in the market drew down quite a bit. So where do you, being that we're kind of heading into that same scenario, how do you see this playing out? Because that liquidity reading there is about as low as it gets, right? So what do you think is going to happen here short term?
There it's going to be panic at the old OK Corral, and they're just going to throw money at the problem to work their way out of it. They have no other choice. It's ironic. I mean, look how good this cycle matches up to exactly what the actions are.
Hmm.
They turned off the spigot here for the last year, and then next year they're going to turn the spigot back on again.
Yeah, right.
Yeah. So what it means to us is buy hard assets. That's all it means. Gold, silver, platinum, palladium, oil, natural gas, coal, uranium. If I didn't already mention uranium, et cetera, et cetera, et cetera. Steel. You know, grocery stores, because the liquidity tap is coming on. Those that own homes that are worried about being 40% down, by the time this liquidity thing back up, who knows how high home prices can go back to. Okay. That's what this means. It's going to be monetize the debt, financial repression, and try to liquefy the governments around the world.
That yeah. That's a pretty telling chart, and it kind of goes into what you've been saying too, and also plays into you've been talking about peak inflation. I think, right? That I think we've seen some things in the last couple of podcasts where you pointed to like, hey, the indicators are telling us that we're probably going to see inflation come down over the next couple of prints. And we have another chart. Tell us about this one, Bob.
Yeah, this one blew me away. I don't know if this is a good chart or a bad chart, Phil, to be honest with you, because it just showed that, a lot of times what the Fed looks for and what the government looks for is like how embedded are people feeling about the prices, right? And we were told all year is that, hey, inflation expectations are now settling in, and it's going to cause a feedback loop of higher inflation. Well, this chart says no way. This said this is a huge reversal in people's views on what things are going to be worth, primarily because they see what's happening to their house and what's happening to the stock market. That's primarily where both people get their wealth from, and wealth effect is a thing. And maybe we should do a podcast on the wealth effect and kind of how it affects the margins of GDP growth. But it is a thing. If you're scared, you don't spend. Okay. And if you don't spend, you actually cause the thing you're actually fearful about happening. And I think that's what we're going into. And I think that's going to tie into that liquidity chart that you had up a minute ago, is that I think we're going to find ourselves into like, oh my gosh, home prices down, medical's down, energy's down, rents are down, used cars are down. You already see it like in the airlines. I came back from Hawaii and I was just perusing around and looking around and saying, hey, I said, hey, honey, we can go back to Maui. You're on $240 ticket. We're like, what? You know what I mean? It just shows you excess capacity is coming back in. They killed off demand as supply is starting to come back into the market. And here's the thing: demand when demand goes away, a lot of people don't get this demand back. If unemployment goes up, you're not spending any money whether you want to or not. You're just not going to be able to. And I think this is and look at the one before. I think that's 2008 when it fell before the market sucked down before that. We've been talking in our room before when the Fed does pivot, that's not bullish for the market. It's actually very bearish because then that's kind of confirmation of things that people already know that the economy is in trouble and the stock market usually follows inflation. That's another tip, boys and girls. The stock market, profitability of the stock market follows inflation. So when we go into deflation, profits fall. When profits fall, stock prices fall. And then you get into the vicious loop versus the virtuous one. That's why the central banks around the world always want to have a slight bias, like a 2% bias for inflation, right? What they could quote unquote tolerate is that it's kind of a mental thing. And people keep thinking the prices are going to fall, like in Japan. What do we have? 20, almost 30 years of falling prices, right? So that's what they don't want because it puts the banks in jeopardy.
Got it. Okay, so yeah, so guys, if you're listening to this only, this chart basically, its median is around zero typically. We're down to negative 5.36. Back in '08 and '09 where we crashed, it got down to almost -8 to give you just kind of an idea of where we're at with this chart. So it's implying that I think the Fed, and Bob, correct me if I'm wrong, but the Fed's going to get their demand destruction that they're looking for, right? And then inflation is going to follow suit.
Yeah, and the important thing about the number isn't the number itself; it's the speed in which it went negative, or where
Right.
the expectations went negative. It's like a 2008 speed.
Right.
So it's going to be interesting.
Right. Yeah. And then tying back into that, where the Fed's going to be looking at if they're getting if they know inflation's peaked, then we should expect to hear some dovish tones from them, right? And sure enough, last night, Evans from the Fed, he's a Fed governor. He said this. This was out on Twitter. The Fed is facing a difficult messaging problem as it nears a decision to halt the pace of rate increases. And it's funny because the last barrage of speakers said basically that don't worry about a pause. We're hiking well into 2023. So it's like I feel like it's back when Powell said 75 basis points isn't on the table, and then 3 weeks later we got a 75 basis point raise. So it's you never really can trust them with whatever they're talking about. It seems like week to week.
Yeah, well, I mean, what I took from this is number one is that they're already trying to change the messaging and the narratives because also earlier this week there weren't a couple other Fed governors who were out there kind of talking about data's getting mixed and stuff like that. And But what I don't get is the Fed is facing a difficult decision messaging. I mean, well, how hard can it be? You get up there and say, "Hey, great news, guys! Inflation's abating."
Right.
We're instead of I think we're going to do over the next couple of times we're going to do 25 basis points and maybe even pause. It all depends on animal spirits and prices. But I think we did what we needed to do. But why is that hard? I mean, these guys should have been in crypto because everything they talk about is cryptic.
Well, it seems like the title of our today's podcast implies, they have a hard time hitting the ball. It seems like, and it's almost like, are you guys doing this on purpose? Like, come on? You got like 1,000 PhDs on the payroll. Let's get it going.
Yeah, look, it's problematic and kind of dovetails into maybe our conversation tomorrow and where the safe haven's going to be. And I want to tease for tomorrow. There's an amazing chart that I'll send to Phil that he's going to talk because we're going to do Bitcoin Friday. I think we settled on that, right, Phil?
Yeah, Bitcoin Friday, and we'll talk about other cryptos. But yeah, correct.
Yeah, so there's a really interesting chart that you guys will appreciate. It would be ironic when you see it and you'll laugh, and because we've been told the opposite for forever. So stay tuned for tomorrow, and I'm really glad you're listening to us, guys, and let us know what you like, in the comments and what you want us to cover. We do this for you guys, and then we enjoy doing it because we live this stuff, but it's kind of fun educating everybody, and also let's all row from the same oar here so we can beat the monster.
Absolutely. And at the end of the day, we want to be profitable in our investments. So, like Bob said, we're covering Bitcoin and crypto related things tomorrow. So, if there's anything that you guys want us to look at on the charts, I'll have a chart up. We can cycle through different crypto tokens that you want to look at. So, in today's comment section, please list those below. And also let us know, do you think we've seen peak inflation? We'd love to hear your thoughts on that, and we'll respond in kind. So I think that's going to do it for our podcast today. Thanks again, Bob, for your time. Thank you guys for your time. Please hit like and subscribe and hit that notification bell. That really gives us a boost to the channel and helps us out and will help us to keep bringing you these podcasts during the week. Thanks, Bob, again for your time and bringing out some of these points of where things are in a macro sense and what the Fed's up against here. I appreciate that.
No, thank you, Phil. Bye bye.
All right. See you guys later. Bye bye.
Trade Genius.